Hey guys, this is Houston Trong from thetradingedge.org. It is Wednesday, April the 3rd, 2019. Hope you're having a good trading week so far. So in this video, I'm going to spend a bit of time just sharing with you some ideas around a topic that I had in mind around what I'm hearing a lot in the media lately. And then we'll spend a bit of time going over some of the charts to recap what I think has been notable so far this week. So I'm calling this video, Why Do We Always Ask Why? And there's been a lot of talk this past week around a couple of news stories. Most notably are, number one, the golden cross on the indices, right? So whether it's the SPY or another index, the media has been talking about the golden cross and the significance of the golden cross. If you don't know what the golden cross is, it's when the 50 period moving average crosses over the 200-day daily moving average, and that supposedly is a good omen or sign for stocks to rally. So they were talking about that late last week about how the cross was going to happen. This week it finally happened, and they're now attributing certain buyers now stepping to the markets and bidding up price because we finally got that cross. Seems to me a classic story where you're looking for a reason for why things are going up. The second story, which is notable, is that's been floating around the media and blogs and so forth, is why has Bitcoin gone up to 5,000? Right? We had that big pop on Monday, Tuesday, Wednesday, and now everyone wants to know why did it happen. And to this point, no one really can pinpoint why Bitcoin shot up the way it did. Question is, why does that matter? Why do we always ask why? I think there's a real innate desire in humans to try to understand why things happen, right? That cause and effect. And I think there's nothing wrong with that. I think that in many ways, it's what makes humans the amazing creatures that we are. It becomes a problem, though, when we begin to assign important decision-making criteria to understanding cause and effect, or letting cause and effect bias our decisions. I'll share with you a really good passage or maybe analogy, actually a metaphor, excuse me, that Nassim Taleb had in his great book, The Black Swan, probably my favorite of all his books. And he talks about the fallacy of cause and effect, of inference. And you'll see where I'm going with this in a few moments. So here's the thought experiment. You have two ice cubes in front of you. And I ask you, what sort of puddle will these two ice cubes leave once they melt? Now, that's a bit of a complicated question. You do have to know a little bit about, maybe physics, or understand the properties of water, and understand the volume of water, and measure maybe the size of the cubes. But you can make a rough guesstimation about what sort of puddle it would leave, right? Would it be a clear puddle? Would it be, a big puddle? Would it be, again, a long one? What would it look like, right? Unfortunately, in the real world, it's not that easy to do that type of cause and effect experiment. Because in the real world, what usually happens is, instead of giving you the ice cubes and asking what kind of puddle it's going to make, it's the opposite. I ask you, or give you, a puddle. And I'm going to ask you, what caused this puddle? Now, out of the plethora of things that could have caused this puddle, maybe two ice cubes was one of the possibilities. It could have been many things. Maybe it was a glass of water was spilled. Maybe a leaky faucet spilled some water on the floor. Maybe a dog peed there, right? You just don't know. There are a multitude of possibilities. That's how the real world works. But that's not how we usually make decisions or look for cause and effect. When we look at the media and we see price move up, we're quick to ask the question, in hindsight, what caused this price to move up? We then imagine a bunch of possibilities and then try to assign them causal effect. The reality is that even with hindsight bias, we can rarely know the truth. Now, for the past month or so, I've spent a lot of time studying some major market reversals. I was planning on giving a talk at the Montreal Traders Meetup this past month around the examination of price action around certain major market reversals, like the 1929 reversal, the 1987 crash, of course the 2000 crash, the 2008-2009 crash. I was going to talk about 2018 as well. And I looked at the price action, examined the history behind some of these events. Read a number of books around, the more popular books around some of these events. And take, for instance, the 1929 event. It's been 90 years since that Black Tuesday. And to this day, there are still debates between scholars about the reason for the crash. There is no consensus around what caused it. Yes, there are some traits and some possible causes, and most people would agree to those things, and we can time them up with some of these things that came out. But what actually caused the crash? No one has any agreement around that, right? Because there's government intervention. There was people trying to regulate certain parts of the industry from being too exploited by margin and so on and so forth. But there is actually no agreed consensus around what caused the crash. And this is 90 years later. Even with hindsight bias, even with the perspective of time, we still don't know the cause. And so, what I hope to instill in you is the understanding that sometimes, as traders, the why doesn't matter. In fact, most of the time in trading, the why doesn't matter. Because the why, by the time you get the why, you'll miss the trade. Because what we do in trading is we speculate. And to speculate means to make decisions when there's uncertainty. And if you wait for the certainty, then that's no longer speculation, right? Then you miss the trade. So, the takeaway is this. Number one, we can all do better around trying to let go of asking why and trying to understand why. Yes, stay grounded in the news, understand events, but don't be so quick to try to assign causal effects to things, because reality is that no one really knows. Number two, find a way to make uncertainty your friend. Because if you don't know the why, you still need to be able to operate in a way that's prudent and in a way that's going to allow you to still make good decisions. And number three, the point of successful speculation, of successful trading, is to have a process which allows you to objectively look at price free of biases. And in a way, it's a truth-seeking exercise. So when we're looking at the charts, we're looking at the news flow, we're looking at the macro and microeconomics. We're not trying to use those things to bias our judgment about where price is going to go. We're using those things to try to simply allow us to trade in the direction that price is going. That means I'm not going to try to catch price at the top and sell there and buy price at the bottom when it hits this line and catch there because of some sort of timing and prediction quality. Because once again, when you try to have that level of certainty, then you forget about the probabilistic nature of markets. and you forget that no outcome is actually determined. So look at the day today for VIX, VXXB. Today was an outside day. The day ended as an outside day. Objectively speaking, it's an outside day. The high here is higher than that bar's high. The low is lower than that bar's low. Now, the day is over. Did we know it was going to be an outside day today? No one could have known. Now the day is done. Can you say that there was a good chance it was going to be an outside day? Possibly. Possibly you could say that. If it had gone to lows, the markets had gone to highs, could you say you knew it was going to go there? That's the problem with these exact words. Because in hindsight, you can say you knew it, but the reality of the matter is that the outcome was a lot more fluid than that. VIX in itself here. Now the day is done, I can say it's an outside day. But at any point in the session here, there were certain turning points that could have changed the outcome of the day. This was not predetermined. Now that the day is over, it's easy to say that it's predetermined. But during the day, had the buyers not shown up at certain points, had the sellers not backed off at certain points, this would not look like the way it did. And we can't ever forget that. We can't ever forget that the outcomes themselves are never determined. So the best that we can do is use a probabilistic framework to try to understand where price is going to go. And that's it. And so with these videos that I'm putting out, the recaps and the outlook videos, I'm doing my best to give you the range of possibilities and not try to point in one direction or another. Your job is to ascertain and weight the probabilities that certain things are going to happen and what you're going to do if those things happen. That's how you get ahead of price. Not by trying to predict where it's going to go, but rather what you're going to do if certain outcomes appear. Now that we know that we have an outside bar on VIX, what are we going to do next? We're not trying to predict where the VIX is going to go. We're simply asking, what are we going to do next if VIX does the following things? Because things are fluid. Tomorrow, VIX could do one of 5 things. 1, it could open up and stay inside all day. 2, it could go up and keep going up. 3, it could go up and then come back in again. 4, it could go down, keep going down. 5, it could go down and come back into the range. Or 6, did I say 5? There's 6, it could go outside bar again. It means it takes out both sides of the range in whatever order that is. Not the order that, not up or down or up. Could be any one of those orders. Down, up, down, up. Could do that as well. So there's many possibilities that are possible. And the only way that we can get ahead of price then is to have some contingencies around what we're going to do if one of those scenarios unfolds. I personally know what I'm going to do with all those scenarios. And some of my actions will be to do nothing. I won't trade the VIX unless I see something that I actually want to trade. I have patterns that I have in mind that I would trade. Otherwise, I would do nothing. Right? And so that's definitely an option. You don't have to do anything sometimes. Sometimes, if price doesn't do what you have planned for it, you don't have to do anything. Because if you ask price to do what you wanted to do and it does something else, and you feel like you have to act, then you're being reactive. As opposed to what we've been saying before, responsive to price.